Drunken fist or drunken boxing is a Chinese martial arts technique that deploys basically a drunken style of fighting to throw one's enemies off. Is that what Trump's doing? We're going to talk about that and look for some stocks that are maybe buying opportunities today on open interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. If you have any questions, please put them into the live chat, and perhaps we will try to get around to those. Very interesting day today. I will mention, something that I thought was kind of interesting. Two things, really, that I thought was kind of interesting. The first is that it has seemed to be Trump's approach or technique so far in this turnaround in his administration to keep his enemies, and maybe his allies too, guessing about what his next move would be. I actually reviewed or asked ChatGPT. I read The Art of the Deal when I was a kid. It came out in the 80s. I was still a student at the time. And I wanted to see whether this kind of approach was something that he was advocating. I was trying to remember. It seemed like I remember that it was, and ChatGPT seems to think that it is, that you want to keep your opponents guessing about what your intentions are, and so it would seem. What's interesting is that, of course, right now there's a lot of people wondering whether or not this was a, intentional, or whether I'm not 100% sure that it matters, whether the administration blinked or whether this was deliberate. But then one of the producers reminded me earlier today while we were still trading that a post went out a couple days ago that said that the Trump administration was going to pause tariffs on all counterparties other than China for 90 days. That post went out on X a couple days ago. It was quickly identified. It was circulated. It was even brought up on CNBC. And then it was later dismissed. And CNN and NPR and a bunch of others sort of described it as fake news. Well, turns out that that post was actually quite prescient. Was it an accidental early release? It's hard to say, but it does seem consistent with a certain type of negotiating technique. The next question, of course, is whether focusing on China is the issue. And actually, I was reminded of a scene from one of the Star Wars movies. I don't know if we're going to actually be able to pull that up.
Concentrate all fire on that superstar destroyer.
That is the scene where one of the captains of one of the ships in the Rebel Alliance says, we have to, I didn't hear it, hopefully you guys did, but if you didn't, he says, we have to give those fighters more time, concentrate all fire on that superstar destroyer. And certainly Trump's superstar destroyer would be China. It's also interesting to me, because I was taking a look at this, and I think we should probably bear this in mind, that China had said that they were going to radically increase tariffs in response to our increases on tariffs. The issue is that we don't actually export that much as a percentage of our total exports around the world to China. And more than that, the administration, and actually many others in Washington, have expressed significant reticence about certain things that we do export. For example, certain technologies which China would like to purchase, which for security reasons we think it might not be such a great idea to sell. Now, it's my understanding that Trump sat down with NVIDIA and that they came to some form of an accord that would, allow the continued sale of certain chips to China. But be that as it may, I thought that was also very interesting. So with that, it's interesting. I had mentioned this on Monday, and I actually went through a list of names, and unfortunately, I don't know how much they're up since, but I had actually formulated a list of stocks that I thought might represent decent buying opportunities I'm going to pull those up on my screen right now. I actually will have to take a look because some of these things may have caught quite a bid today, especially Broadcom for sure. That's going to be on the short list. What I was doing was I wanted to just show a couple metrics that we might think about when we're looking for stocks that we think could be good buying opportunities when the market really gets hit. Now, I should point one thing out. I'm going to show one thing on my screen first, and then we'll get back to this. So this is a chart of the S&P. I circled a section over here on the right in yellow. We filled, this was an unfilled gap on the way down that we have subsequently filled. There is one other. That level is going to be up around, let me see what it was. I think it's just around 5,600. Might be 5,571. Yes. So the low was 5,571. So that's the presumptive gap fill. And as I previously described, the multiple for the S&P leading into all of this was quite elevated, right? It was quite extraordinary. And you can have vicious bear market rallies. My assumption, we did actually, I think, get into formal, I think this ticked the formal bear market. The peak to trough may have actually ticked it. So, but I do think that we can probably, at the very least, begin to think about selling some upside calls against longs. Yeah, so that actually did tick into official S&P bear market territory right there. But I do think that one can start considering selling some upside calls against stocks once we get into this region right here. Okay, so stocks that I thought had gotten quite cheap. Some of these stocks, I had formulated this admittedly before we got today's wild rally. Oh, actually, one other quick point about today's rally that I just think is probably worth mentioning because I rarely talk about this. We had a treasury auction today, and that treasury auction was pretty well received, actually. So I'm just going to go to this. I just want to show you guys something. The bid to cover on the 10s was actually quite high. So I'm going to show a 5-year on this so you can get some sense of where we were. So this was the bid to cover today, and I'm going to just give it some over 5 years for these auctions. There we go. All right, so upper end of the range. I think Rick Santelli on CNBC pointed out that he was giving the auction an A. I thought that was interesting. People can decide whatever it is that they want to, I suppose, about the fact that there's 24 primary dealers and they were participants. They were willing to get in there and buy treasuries, even as most of the media stories were about a deleveraging trade, which would suggest that you're going to see unwinds all over the place, and that would help explain. Look, I mean, we've had a big rally in 10-year rates, so that's not a great thing, and it's not what the administration or anybody else wanted to deal with that interest rate expense issue that I previously described. But that is it is what it is. Okay, so let's get back to this list of stocks. So Broadcom was on it. That opportunity, unfortunately, because that was top of my list, probably going to be a little bit tough because the semis just caught a huge bid. Yeah, look at this. This is up 18% day over day. And let's see what it was off the lows. Is that actually up all day? Nevertheless, we'll give this some historic context. I'll just tell you what it was that I was thinking about, and then we'll look for some potential opportunities. You still have a gap in there. But it's still well off the highs, right? So not as good an opportunity as it was when I put it on my list, but maybe I need to start doing Twitter Spaces so we can start, speaking in more real time, something along those lines. But let's just take a quick peek at what it is that I was looking at when it showed up on my list. So what was I looking for? I was looking for really hard hit stocks that were anticipating year-on-year free cash flow growth of a decent amount and had a good free cash flow yield, right? So, I wasn't looking to see what sell-side analysts thought about these stocks or anything else. I think that sometimes can cloud your judgment. Edison's on this list. I had previously mentioned utilities last week, so, if anybody was watching that, then you would already know this. But that was, and even now it's probably not so bad. But we've got good free cash flow yield, almost a 3% free cash flow yield, and also, importantly, very good year-on-year anticipated free cash flow growth. Edison, utilities generally have very good dividends. I don't have really good free cash flow numbers for you there, but this is just one of those spaces. NVIDIA, not going to surprise anybody that... I've mentioned it on more than one occasion. This thing was starting to become very cheap. You've got the thing was trading less than 20 times forward earnings with still exceptional free cash flow and growth. Pig in a python risk, but still very reasonable. APA, I know this got mentioned last Friday. I think Mark said it was one of his favorite stocks here, but that's another one. Host Hotels, this is run by one of the Marriotts. Another potential name, Smurfit Westrock, ticker SW. Again, really handsome free cash flow yield. Diamondback Energy, so this free cash flow yield number is, I don't know, this, I'm not sure what that's coming from. That's not correct. This is actually the best estimate for this coming quarter's free cash flow yield. So this is the quarterly, just so you know, over here. This one over here, Vistra, which I've also previously mentioned, still like that. That's in the utility space, but more growth-oriented. Very nice free cash flow yield. You can see was over 7%. Let's see where this thing is now. Probably not that high now. It's probably in the 6s, depending on how big a bit. Oh, my God. Yeah, it's up 15%. So, whoops, I've got somebody pinging me on the side here. I'm going to just try to make sure that I'm not accidentally sharing their chat where I should not. Exit. Okay. So Vistra, and then Apollo Global. And by the way, I don't know if anybody caught this, but Rowan was on, I think it was Squawk this morning, talking to Andrew Ross Sorkin. So if you're interested in, Apollo, which is another name on my list, you might want to see his interview on CNBC. I'm sure you can probably find that on YouTube or somewhere if you Google it. So the CEO, Ron, was on with Andrew Ross Sorkin. And he was remote, so I think Joe Kernan also asked him a couple questions. So there you have it. That's, people were asking for a bunch of names that I thought were appealing. There we have it. And we may get some other opportunities. Like I said, I have a feeling that if we get back to that 55.71 level, that we might run into some resistance, and could arguably turn lower from there. So that's definitely a distinct possibility. Okay, so let me see very quickly if we have any questions, because I've got it up on the wrong screen. Double check here. I think. We do have some questions. Okay. Tucker D. Dog. I thought Apple did 80% of manufacturing in China. Why is it ripping today with tariff news when China tariffs increased? Apple, I'm not a buyer. I think I've said that before. I think it's important to recognize that a lot of the biggest stocks, like the Mag 7 stocks, regardless of whether or not they have a fundamental justification for it, are going to catch a bid on just the passive investing side. Let me just say. That's one of the things about Bloomberg. If you're logged onto a Bloomberg, people can ping you and you get a chime in your ear. So I'm just letting this person know that I'm actually busy. Okay, so not a buyer of Apple, but that doesn't mean I'm not a buyer of any stocks, as I've just articulated. So, FinWest, good morning, Mike. I've not seen so much green on my screen, but this only takes us back to last week. Let's see if this rally has legs. Like I say, I think the next potential gap to fill is going to be that 55.71 level, which was the lows from whence we fell into this big thing. So, yeah, right there. Last Friday, SPX 5000, you suggested a 4,300 put spread. What was your thinking? I thought we would have more weakness, and we did. That actually was profitable. It's interesting. So I made some money on Monday, not as much as I could have, because I think I alluded to this when I did the live stream about trading system problems, why they never ever seem to go in your favor. I had my trading system locked up. It didn't recognize the contracts I was trading. Contracts it had gotten me into, it did not recognize when I was trying to get out of them. Be that as it may, stuff happens. Can't really blame your system. I can blame the fact that I was put on with trade support on hold for ages, because apparently a lot of stuff was breaking. But yeah, so what was my trade today, by the way? So I came in today, and I did not carry this overnight. So I came in today, and the very first thing I did was sell a $500 SPX strangle, 0 DTE in SPX. Then I closed that profitably ahead of the auction, because I didn't want to carry it through the auction. I wanted to see how the Treasury auction, which was at 1 o'clock, would go. As soon as I saw the auction results, and also saw that May implied volatility for SPX was about 39.5 at that time, I then sold a 1,000-point May strangle, and I covered that very shortly thereafter, within minutes, simply because I didn't know how far. I don't think if you had asked me, I would have thought that the market was going to threaten the upside of that strangle. What I was doing was trying to be delta neutral, but short vol, because I thought vol's going to come in hard on this news. The combination of the auction and then the tariff news. But when the tariff news really started to get digested, it was funny because I sold the strangle on the auction and held it as that tariff news came out, and was thinking, what's going on? This is good, but it's not great. That's when I ended up covering that puppy. Interestingly, even though it ran not up to or through that short call strike, the decline in implied volatility was enough that this was well before I closed it, by the way. I would have made another another few $1,000 per strangle had I stayed in it, but I just covered it because it was pretty clear anything could happen. So also on this the 4,500 put spread, I don't know if that was exactly the one that I had specifically recommended in my article last week, which was published by CNBC. I had actually recommended last Wednesday the 550-500 and had suggested rolling that down, because by midday Friday, that thing was already to and actually through the short strike. So that definitely needed to be monetized, and so I was encouraging people to adjust that thing lower. But I do think also, we're in a higher implied volatility environment that's good for overwriting. You'll notice that the trades I just described, having done myself over the last couple of days, were short premium trades. Just because, from my perspective, although my sense of it is that I set the 5,500 strike because I figured the 5,400 level was going to be a difficult one to breach. The the run-up that we saw this afternoon was one of the sharpest I've ever seen. I'm trying to remember, actually, if and when I saw something bigger and stronger than that. Okay, so Michael Walter, your thoughts on a Dec QQQ risk reversal? Well, let's take a look. Let me pull one up. By the way, folks, we're coming into earnings season. Delta is going to be the first one to report. I had put out a story on that. I had also described a call spread risk reversal. I don't know if I talked about it here. Bullish. If you didn't see it, the CEO of Air France KLM was also on Squawk this morning. And one of the comments he made, which really caught my attention, I thought it was quite remarkable. So there were three things that he talked about. The reason he was on, to start with, he was there to essentially promote some new transatlantic, ultra high-end, first-class service where you get you have your seat and then a separate bed, and you get Michelin star quality food supposedly and stuff like this. And a round-trip ticket is coming in around $15,000, I think, for something that's supposed to approximate, basically they're trying to be competitive with charter jet services at obviously a far, far lower cost. And they apparently they have, like you get different treatment at the airport also, so probably private entrances and all that kind of stuff. But they were talking about that. That was one of the things that I thought was kind of interesting, that they were reaching out and trying to go for that ultra high end, because the ultra high end, assuming that they continue to travel, are not likely going to be affected by anything that's going on. The other point, 2 points he made. One was that although they had seen some softening in demand from economy, they saw that there was decent flexibility when they tinkered with the prices. So when they started to see economy seat demand drop, they reduced their prices a little bit, and immediately that was filled. So it's not like there's just nothing but air under there. Talking about airlines, why not? And then the final comment he made, which I thought was the most remarkable, they are seeing the highest load factors in the company's history. Now, I thought that was really interesting. Now, for what it's worth, so Delta is going to be reporting tomorrow, and Air France KLM does not have domestic U.S. travel, but they do have a joint venture with Delta. So it's a big joint venture. So Delta, that's the if you book on Air France KLM, and it's going to involve domestic travel within the United States. So you have somebody coming over from Paris, goes to New York, and then on to Houston or whatever. That they are partnering with Delta for that. So that's just interesting. And Delta had been very hard hit. In fact, actually, I'm just going to pull that chart up since I'm talking about it before I get to this QQQ business. But you can see here, this one, oops, that's not it. DAL. So this thing is, down a ton. And, based on his comments, maybe not so bad. And the other quick point, just something to think about. We had, although this reversed too, I actually sent out a post when oil was down this morning. I said, buy some oil, put it in the SPR. So much for that opportunity. It was really short-lived because oil ended up higher on the day. But, yeah. So let's take a look here. Dec risk reversals for the Qs. Let's pick one out. So first of all, if you're thinking about a Dec risk reversal in the Qs, if you already own tech stocks and you're concerned about a potential downturn, you could, so I'm just going to impose the stock, you can sell off some upside, buy a downside put spread, you get into a synthetic call spread risk reversal that way. So this could be a good way to, ensure that you can maintain your positions if you want to. One quick point I would make, and it's totally up to everybody's tax consequences are different. You might be using a tax deferred account, or there may be other offsets that you have. I would just make the one observation that all else equal, usually if I'm thinking that far out, It's not a big difference between December and January expiration, but you could potentially not have a tax consequence on a portion of the trade if it expires after the end of the year. Not tax advice, but I'm just making an observation. Not a huge difference between December regular way or December month ending and January in terms of expirations, but there could be. So, think about that if in case that matters. Okay, so let's just take a look at what this would otherwise look like. So the first thing I'm going to do here is we're going to impose a put spread, because that's essentially what a call spread risk reversal would be. It would be something like this. Let's hedge against a potential downside. What am I doing here? What's going on? Actually, you know what? I'm going to go out to January. Why not? Because that's what I was talking about anyway. So, okay. Let's see here. So we're going to sell an upside call. And, we've got these highs up in here around 525 in case you think it's going to bump its head in that neighborhood. You would sell perhaps a 530 if you think perhaps that there would be something like another 10% potential downside in here. I'm going to get rid of the stock for a second. We're going to reintroduce that in just a moment. So we can take this down to call it. So let's assume that you're just looking for some form of disaster protection or something like that. This is going to be pretty close to flat. Okay, so that's if you have a tech stock position already, you would end up with something that looks a bit like this as the hedge. This is actually synthetically, when you incorporate your long stock position, this is effectively a call spread risk reversal. And to illustrate this, I'm just now going to add the stock back in, and you get this. Okay, so this doesn't have any net layout of premium per se at these levels. The reason that you have a little bit more downside participation before your protection would kick in is because you wouldn't be buying an at the money one. I'm just saying 450, which is basically right in this level right here. So that's that gap up that we just filled. So I'm looking at that level right there. And then, you're trading a 453.90. So a $60 put spread. No net outlay of premium. So $60 worth of downside protection versus where we are right now is about 12.9% of the current spot price in terms of downside protection in the event that things really washed out. Another way to think about that, and I'm not saying this is the way people would normally do it, because often they don't. Oftentimes, if people have hedges against a core equity position and the market washes out, you do monetize it. And that way, and you could monetize it and reset to lower strikes, or you can just monetize it and have mitigated some of the downside. But how much downside would you mitigate? Effectively, if you've got a 15% washout here in your head, carrying it all the way to expiration, the effective mitigation would be about 12.8%, we'll call it, of the 15% decline. So you'd basically be protecting against most of your downside risk. And you'd have upside participation to the short strike, which is 530, which is above or at, or very close to, I should say, these February highs. So that's worth thinking about. And as we've discussed on prior live streams, there was a lot of optimism built into prices. Everyone's acting like, oh, that's it. Everything's good. Nothing to worry about. For the reasons I previously articulated, the forecasts assumed they were extrapolating essentially from growth rates that we've seen in S&P earnings coming out of the pandemic. And that is a pace that is higher than we have historically experienced. There are other things going on here that can constrict GDP. The predominant assumption from the sell side analysts was that we were going to have the upper end of operating margins, 14.5 plus, which is not the all-time highs that we've ever experienced, but pretty close to it. So, that was the assumption. So saying trade or fade this rally. I literally was just hitting Carter before I came on here right now. What do you think? Sell it at 55.71? And from a technical point of view, because I feel like we're in a very technical market. Yeah, I mean, so that's incorporating my fundamental view that the market's very fully valued at those prices. I had previously said that, my fair value assumption using a median operating margin with a predominant view that GDP is going to be flat to maybe down slightly, so that we experience a recession within the next 6 to 12 months, that would suggest a 42 to 52.50 range. We were inside of that on Monday. We're outside of it now. So I think we get to 55.71. I think at the very least, start selling some upside calls. Maybe put on things like put spread collars against the whole book. Be another thing you could do. Or maybe take profits if you have good offsets. So, if you have some losses and gains that you can pair off against one another, that might be a good time to rebalance. And so no 5, it's a trap. Yes, that's a good line also from that movie, but it also could be a good reference for this market, I suspect. And Steve B, yeah, you're asking the same question. These are all very good questions and very, very reasonable. So do you think the Trump put is around 5,000? Yet again, VIX greater than 60 always quickly reverts. This appears to be some major intervention to correct the markets when the VIX is that high. Yeah, I mean, when the VIX gets to these types of levels, you are typically going to see some good snapbacks. And that's simply because, when it's over 40, that usually is indicative that, there's that anxiety has turned to fear, if not outright panic. And, that means indiscriminate selling. Indiscriminate selling usually reverses. Now, in this case, it didn't reverse simply because of indiscriminate selling. It reversed because we got this news. Today is the 9th. That's a good point. So that delta, if you guys didn't put on that delta trade that I had previously written about, I apologize. I just said that. I'd written about it, and I had it on myself, but for some reason, so today is the 9th, not tomorrow. So delta is already out. I still, I'm still with it, though. So probably because it didn't get a big move today. Let's see, where are we? Let me double check what that result was. Let's see what Delta's got. So busy listening to the CEO of Air France. What do we have here? And so what did we get out of Delta? We got just under 46 cents a share reported. And, we got a good move in the stock now. Still, we're still well off the highs. Yeah, it's kind of too bad. Like I said, I guess I'm going to have some spaces to get into. Look, one way to look at this, if you read those articles, so if you read the article that I wrote on the Options Edge or on CNBC Pro, or heard my previous comments, then maybe you were already in this trade. But I'd give you the following, which is some consolation if you didn't. And that is that we are, this stock was trading almost $70 earlier this year. It's 45 now. Okay. Is it unfortunate if you didn't happen to, and look, by the way, I wrote that article last week. The stock was just over 40 when I wrote it. So it actually is not that much higher than when I wrote the article. It's up a lot from the absolute lows. I didn't bottom ticket. But, that happens, and sometimes you're better off. Sometimes, here's a question for you. Would you rather own the stock at $42 ahead of earnings, not knowing what the result would be simply because I wrote an article saying you should? Or would you rather get along at $44, up $2, up 5% from when I said to buy it, now that you had a big earnings beat? I would actually argue it's a better buy now that you have more information. Wasn't just Mike Coe's speculation. So I don't think that changes a whole lot. So I don't let those kinds of things stop you, by the way. It's just a general statement. Somebody like me or anybody, doesn't really matter. Analyst comes out and says, oh, buy a stock, and you catch that news a little bit late. I mean, I said it early, right? I mean, I said it, we can go back and look at the timestamps and see where I got it, but, it certainly went down before it went up. So, you're never going to pick the absolute bottom. Okay. So, but yeah, thank you for bringing that to my attention. That's important. So, Trump is saying he decided on a 90-day tariff pause because people were yippy and afraid. I wonder, does that include himself? Tucker D. Dog says. Well, he's a golfer, so we know what yippy means if you play golf. If you have the yips when you're putting, that's never a good thing. The thing is that, like I said, I don't know that any particular narrative is all that important. I actually said that on a Spaces about Bitcoin yesterday. We can try to figure out why we think people do the things that they do, but it's more important just to see what they do than really get into their heads and understand why they do it. Somebody was asking me, why does he have to do drunken master negotiating techniques and constantly keep people on their heels? I mean, is it a good approach? Is it a bad approach? Does it do more harm than good? I'm not 100% sure. It strikes me that if your counterparties have to do everything by committee and that's what you're up against, you probably do have some form of a strategic advantage if you can pivot constantly and leave them guessing. It's not the approach I would take, but it is what it is. Like I said, I think this presents us with another opportunity, because if we get back up into this 5,600 area in the S&P, what did I say my number for that was? I think we were at something like 5,600. Yeah, I think we were at somewhere in the neighborhood. So here's one way to think about it. At the mean multiple for the S&P to forward, we'll call it 18, right? So if the S&P gets to 5,600, then that would imply, at the mean multiple, that would imply $310 in S&P earnings. That's not going to happen. But could we get into the high twos? We could. But here's another way to think about that. Let's say we get to 285. Okay, so we get to $285 dollars in earnings full year for the S&P. That's 19.65, right? And it seems to me that that would be achievable if we manage to avoid a recession. But is that a terrible place to at least cap your upside or try to grab a little extra premium by selling some elevated call options? Doesn't seem so to me. I think this is a good opportunity. I think it's a good opportunity, especially if we get up to 5,600, to start selling some upside calls. Okay, so Anil says, Mike, I took a position on VIX futures calendar spread April May 21. So when you say VIX futures calendar, I'm assuming you're just trading the VIX futures. And what are you doing? Buying May and selling April? If you don't mind clarifying, Anil, before I answer that question, that would probably be helpful. For those who are not totally familiar with the VIX, so we have the VIX that gets commonly cited is what we also sometimes refer to as spot VIX, which is not a tradable instrument. Spot VIX is a volatility calculation that takes a weighted strip of S&P options that expire in 30 calendar days, if it exists. And if it doesn't exist, it takes, so let's say 30 days away is, falls on a Saturday or something like that. Then they interpolate that point in the volatility surface. So it's always basically a 30-day forecast. It's just like you turn on the weather and they say, what's the weather going to be in a day? Or in a week or a month or whatever. It's always a 30-day forecast. And that's why you can't trade it. In the same way that I cannot buy a 30-day temperature forecast for July right now and say, well, I think temperature, I'm going to right now buy a 30-day forecast that says the temperature is going to be higher in July when they typically are. You can't trade forecasts, but you can trade futures. And that is when you look at VIX options, those options are on the futures. So that means that every expiration has a different underlying. So this is different than equities. This is more like any other futures that you're going to be trading. You trade crude. If I trade June options, that's on the June future. And by the way, the futures and the options have different expiration dates. Generally speaking, the options, well, they have to because they settle into the futures, expire before the futures do. And let me just see if we got Anil has not yet responded. But let's just take a look at this generally. So if you are looking at the VIX, then the first thing you're going to be interested in is the term structure of the VIX. And what we're talking about in this case is the term structure, because I use the term structure in two contexts. When we're dealing with futures, there's two term structures I'm interested in. The term structure of the futures, which you can see are in backwardation right now. What that means is that this is spot VIX, so this is where we closed today. You can see it fell precipitously, but this thing was over 50 at one point. This is the first VIX future, which is 2840, which is well above average. And this is the next one. So April, May. That means you could, if you're only trading the futures, you could buy May and sell April. If you did that, what are you betting? You are betting in that case that that spot VIX is likely to drop, because what's going to happen is the multiplier on both of those two futures contracts is the same. You're betting that the near one's going to come down more than the next one. Okay? So that's the first thing I would say. And actually, to illustrate this, let's go back and throw in another one. Okay, so you see what's happening here? So now I have a month-old one, and we can take a look at the futures. And I'm just going to do it because this is not in terms of, although these are sort of measures of implied volatility, I want you to just realize that in this case, you're going to get a multiple on it. Oops, of the future. Okay, so if we reverted, if I was long May, short April, you can see that the April future, if it just reverted to this, would be down 7.65, and the Mays would be down 4.48. So when you're doing a term structure trade in the straight futures, which I'm assuming is what he's talking about because he didn't reference any options or strikes, then if you're long May, short April, your betting vol is going to come in. And if you're long April, short May, you're betting that this is going to actually go in the other direction and steepen. And I don't think I can... Here we are. So now you can see this was yesterday, right? So that was before this recent news, before the Treasury auction. And you can see that the Mays were trading 39.4. And I'm sorry, that was the Aprils were trading 39.4, and the Mays were trading 31.5. So 31.5 down to 25. Wow, that's a big decline. So that's 6.5, but obviously the Aprils fell substantially more. So those went, again, as I was saying, about 39.5 down to 28.6. So 11 points in the April VIX future. For now, it does seem like things are coming in. And if we get back to that 55.71 level, vol's going to come in further. It's going to come in, functionally, it's going to come in for two reasons. One, if the S&P is rising, that's indicative that the market is less pessimistic. But there's another reason, and that is simply skew. As the S&P rises, you're going to higher strikes. And, that's what I was talking about with Brian last week. Actually, I should have had Brian on today. And in fact, I did reach out to him because, of course, we were doing... Oh, there it is. Yeah, so 36 minutes ago, he said he'll be joining us next week but he wasn't able to today. He's actually in a panel right now. Okay, so hopefully that helps. This is, there was Steve's question about trade or fade, basically. Asking the same question. PC was asking how I selected the strikes. The strikes that I was selecting on the put spreads was related to rolling down the 550-500 if you were doing it in SPY, or the 5500-5000 if you were doing it in SPX, which I had articulated last Wednesday. So it was basically a similar distance, right? So it was about, give or take, it was about 10%. So it was, I was looking at the 550-500 in SPY, which was just under 10%, 50 bucks over 550. And, once we had gotten to, or actually through, the 5,000 level in the S&P, the 500 level in SPY, just taking that and rolling it down. Admittedly, a little bit arbitrary, and this actually is kind of an interesting point. I'll make this quickly. Sometimes I have in the S&P what I've done, not so much lately because vol hasn't been cheap enough and skew hasn't really set this up favorably. But in late 2019 and early 2020, I saw that I was able to get out of the money tight put spreads in the S&P with very attractive payoffs as disaster protection. And when I say payoffs, what I'm saying is I could pay, maybe 1/7 or 1/8 of the distance between the strikes. And the way I was thinking about it was, well, as a disaster trade, if this thing, it's just basically teeny put options in a way. And if vol goes up, they'll probably catch a bid. If the market comes down a little bit, they'll probably catch a bid. So you kind of have to, every market's going to be a little bit different how it sets up. If you have a really low volatility environment, then you don't have to get so creative and use spreads, because those of you who did use them, including the 550-500, by the way, I'm sure you noticed this, because we went into such a high vol environment, it's not like it monetized the whole thing on the way down. So, they probably, they doubled, a little more than doubled in value. So you probably got like 150% P&L on the long put spreads, depending on where you took them off. But it is a little bit of a tricky thing with these put spreads if you're paying too much premium for the distance between the strikes, because in a high vol environment, there's always going to be considerable extrinsic value. And consequently, the only time you're ever going to see those put spreads go to their intrinsic value is if vol is very low or there's very little time to expiration, some combination of these. So that's one of the reasons why, I might widen out those strikes more than you might think, even net of a decline, because, I'm looking for a little bit of a little bang for the buck there. Thanks so much for coming in our Wolf Bitcoin space yesterday, Mike. I love those things. People who are watching, you guys should probably check them out. I think it's really, even if you don't trade Bitcoin, or if you're not a Bitcoin investor, and I'm on the record as saying that I think you should be, but even if you're not, you should listen to some of these spaces, because it's an interesting global macro conversation about the state of the world, of debt, of money, and economic issues, regulation. These are all things that are very important to people who play in the crypto space. And it really matters to everybody, no matter what you trade. So if you're just a bond investor, I'm going to guess that if you ever listen to some crypto spaces, you wouldn't just be a bond investor. And you certainly wouldn't have a lot of duration. So I recommend it. And I was glad that they had me. It popped up. Darkside, who has been on this live stream, a guy I've known for a long time, smart guy, entrepreneur, very successful crypto investor. When I follow him, and so if I happen to see he's on a space when I'm poking around on X, I'll try to listen in. At the very least, I'll try to listen in. Steve Garcia, that I want to say that 90-day tariff pause news on Monday denied then implemented, raising eyebrows for sure. Yeah, I don't know how that leaked out. Obviously, somebody started to talk, and I mean, here's the thing. Normally, you know what they say? Everybody's heard this. You know, rumors coming out of Washington, you can't believe them until they're officially denied. And they officially denied that one. And lo and behold, here we are a few days later, and it's exactly what was forecast. 90-day pause on everybody but China. And they really tried to make it, and it's interesting because the way the story broke, it was as if it was a last-minute decision. And the reason I say that is because even CNBC, it was being reported, Bessent was supposed to go to a meeting, but he canceled that meeting and raced back to talk to Trump, and then they made this announcement. The same announcement that they supposedly made and then withdrew days earlier. You know, if you're playing this kind of drunken master stuff, you know, they don't want it to seem like it was all planned. Because that makes it very. How do you deal with somebody if you think he's just making decisions off the cuff? But the fact that leaked out a couple days ago and then it comes out as described does make it seem like this was a little bit more deliberate. I'm sure people who think that, people who are suspicious, they are going to say, you know, we were talking about what was happening and now. You know, who knew? Not like, oh, who knew, but who knew? Who actually knew what was going on? And why was the bid to cover so good as everybody's talking about treasuries going down? I'm not trying to stir up any conspiracy theories or anything like that, but I was surprised by that. Let's put it like that. Made me wonder. There's 24 primary dealers. I worked at Cantor Fitzgerald, which is one of them. Did make you wonder. Anyway. Okay. Sell April, buy May to get gains in the difference. Yeah, so, Anil, I hope you understand this as you're looking at this chart. This is a very important thing. I was actually asked, not going to say by whom, but a few years ago I was asked to serve as an expert witness for an institutional firm, New York-based, their offices are in Midtown, that had been advised by Morgan Stanley to do a trade just like this. And so they were basically long the calendar in VIX futures. These things do not have to converge, okay, just so we understand, right? If vol goes higher, the spread's going to widen. And if you're long May, short April, you will lose money. Simple as that. Because this is where we're here. It's white. If VIX spikes, it goes here. That's orange. And if it falls, it goes here. That's blue or lower. You know, I mean, these are representative, but I just want to give everybody an understanding that it is not a risk-free trade in the sense that you say, oh, I'm buying 25 vol and I am selling 35 vol or something like that. You're playing off of the shape. And if you are long May, short April, you are playing for it to flatten, or you're paying for it to actually revert to some kind of a contango. And if you're in the opposite, you're expecting the backwardation. That's how much spot and the near-term months are trading over the long-term to steepens, right? So that's the kind of vol cone you can get. That's fine. And by the way, my guess is that unless we get some negative news coming out, this probably will fall tomorrow. So my guess is, you know, someone says, okay, you have to buy that trade or sell it right here, right now, and you have to hold it until tomorrow's close. My guess is this curve falls. You like that? Okay. You know, I'm not in the trade. I'm just saying you forced me to do it. That's the way I would put it on right now. But just understand that, you know, you get some kind of negative news and white goes towards orange, not towards blue. Okay. So let's see here. The ex-Andrew, I think someone else capitally injected things. Maybe someone who doesn't like tariffs. You know, it's interesting. So I don't know. I'm going to make this this comment. And I'm not the only one who's made it. Muhammad Al-Aryan was talking about this, I think, earlier today. The thing that a lot of people have been asking was when is the Fed going to step in, or is the Fed going to step in? What would they do to step in? Why would they step in? Or can they even? So the Fed has dual mandates, obviously trying to prevent a recession and maintain full employment. The two are inflation and employment. Those are their two mandates. And serving two masters is a difficult thing. The Fed's hands are tied, in my view, right now because tariffs are, or at least, the very least they were, inflationary. So if we impose a tariff of 125% on Chinese goods, now we had tariffs in place, so I don't know, is the 125 inclusive or exclusive of the pre-existing? Maybe one of you can tell me. But let's just start with that, okay? So, and let's use $500 billion, okay? The number I think is a little bit higher, but that's also 2024's published number. So $500 billion of Chinese imports at 1.25 is $625 billion in taxes. Incremental. That is inflationary. So that really puts the Fed in a tough spot because their first order of business is going to be trying to keep a cap on inflation, and they haven't gotten it down to the target yet, right? And on top of all of that, it's not like we have a really severe unemployment problem either. Even if we start to see some things that indicate that we might be heading in that direction. And we have seen some of those signs, by the way, if nobody's been paying attention. The number of job openings has been declining. So there are other signs. But, inclusive, thank you. The ex-Andrew says that's inclusive of the others. Okay. But this is inflationary, so that really does tie their hands. But what might they have done? Because the real disruption that we were seeing over the last couple of days in rates that I think a lot of people were concerned about was this one, the 10-year. This is some violent stuff we're seeing in here. What typically happens when the market gets under duress? Well, what typically happens is what first started to happen as all of this unfolded. And that is that there is the flight to quality, flight to safety, risk off, whatever you want to call it. And what is usually going to accompany that? Treasury yields typically go down because treasuries are viewed to be an area of safety. The dollar often goes up in these kinds of cases because the dollar is considered to be safer. And at first, this was the kind of action we had. But then we got this divergence. Treasuries started dropping, meaning that the 10-year yield went up, and the dollar started dropping, which meant that if people were fleeing to safety, well, of course, there's some sense of that. That's kind of the same thing, right? But basically, it means that people were selling treasuries and they were buying non-dollar denominated assets with the proceeds. If you take a look at the euro relative to the dollar, it was strengthening. So that was viewed arguably as a flight to safety or flight to quality. I mean, it's not like they don't have their own problems, but that's kind of the concern. The Fed is aware that we have this big interest rate bomb that's going off as we speak. Long-term treasuries fall too much. That becomes a real problem. It becomes a real problem because it's $90 billion of incremental interest rate expense per point. And so, if we were at 390 and now we're up at 4.5, we got up to there, as you can see today. So it's come off since. And the Treasury auction was I think by most accounts a good one. So that was why people were watching it so carefully in part. If the Fed was going to come in, I think that's probably where people would have expected it. Are they going to go and try to support the long end of the curve and add to their balance sheet again? Now, it should be said that in a way, they could have defended this because Powell did say, as you will remember, in his most recent remarks, FOMC remarks, he did say that they were going to slow the pace of the decline in the Fed's balance sheet. And so one can imagine that as in the course of those manipulations, if they wanted to prop up the long end, which would suppress rates, so prop up those bonds, suppress those rates, then that's essentially what I would expect, which is that as short-term paper rolled off the balance sheet, they would just extend it. That was my guess. Okay. All right. Oh, and actually, the ex-Andrew, by the way, I appreciate, I mean, you're getting right in there. You got a lot of things to say. I'm having a hard time keeping up. Specifically inverse. What are we talking about here? Oh, okay. So you were asking about CRWV, but you're in specifically inverse hedge synthetics on IBIT. So that's the Bitcoin ETF. Inverse hedge synthetics. What are you referring to there? Using synthetics as a proxy or reversing or converting? I'm not 100% sure. Oh, separate topics. Okay. Well, I'll tell you what, since we've already chewed up an hour, I'm going to take a look at that. And if you have more, put it into the comments section so that I can understand exactly what your questions are and contemplate them and come up with an answer, which I can discuss on Friday when we have Mark Guthner with us, who, as you may or may not know, he's also, he mines several cryptos and has written pretty extensively on Bitcoin. He's definitely a Bitcoin bull. And so we can talk about IBIT and some other things as well. I did happen to say to Dark Side, if you don't follow Dark on X Spaces, you might not know this. If you want to know more about the crypto space, you should probably follow him, and then listen in on some of those spaces. But I did say that I viewed this whole thing as a win-win, as far as Bitcoin is concerned. I mean, that's kind of my take on it. You're going to get some volatility. It's going to chop around a good bit, but that's sort of my take. All right, so should I do? You know what? I'm just going to put these names up. We're gonna wrap up this because it's been over an hour, and I really appreciate your time. But I just wanted to throw that up on the screen so you guys will be able to pause it. These were the names that I was thinking about. Vistra, Edison, Broadcom, all of these, yeah, they got big rips today, but they're still well off the highs. And you might get another chance to buy them a little cheaper. I think we're going to get a fadeable rally in here. 5,600 is the number I'm looking at in round numbers in the S&P. Like, subscribe, notification bell. Tune in on Friday at 2 o'clock Eastern Time. Thank you very much for watching.